Thank you, Chairman. I had a series of fairly specific questions. First one is linked to country-by-country reporting. You talked about the 750 million euros of a company's turnover where reporting is mandatory. This would leave a large number of companies out, about 80% or even more. Are you not thinking of having a lower threshold in the future so that a large number of companies, most companies, would actually avoid that obligation? Secondly, the impact study that was mentioned, which we hear about in April, on the publication of this information. I'd like to know whether it's the Commission services who are going to be carrying out the study, or has it been given to an external assessor? And if that's the case, which company was asked to carry out the impact study? Was it PwC which carried out a similar study on the banking sector? On the limitation of interest rates, OECD talks about an interval between 10 and 20%, a range, if you like. The Commission has opted to go higher. Why? What criteria did you use to, as far as maximising interest rates were concerned? And also, in the attempt to limit the possibility of using interest rates in that way, how are you leaving financial companies out of that? And when it comes to controlled foreign companies, the rules governing them, the idea would be that profits would be taxed in the member state of these controlled companies. There are various criteria, but there's one that I'm interested in particular, that the third country tax rate will be lower by 40% than the rate in the member state concerned. What was the reason for arriving at that? If in one country it's 30%, for example, then we're talking about the profit being taxed at a rate of only 20%. That is another threshold which I think needs to be revised and revised upward. Finally, these rules, I'm talking about foreign company rules, don't seem to work in the area of the EU. Why aren't these applied in the European Union when the main countries concerned are actually EU member states? Thank you.
Monsieur le Commissaire.
Commissioner.
Indirect à Monsieur Fox, nous restons.
As I was saying to Mr. Fox, we are working on the basis of the OECD and BEPS. The directive is a minimum standard compliant with the OECD. 750 million euro is the OECD figure, and the objective is to target multinational companies which have the wherewithal to tax plan aggressively or to use tax optimization mechanisms. As far as the Commission itself is concerned, we are following the work of the OECD, but member states can go further if they like. On studies, into that publicity work, this is something under the aegis of my colleague Jonathan Hill. His departments are looking into impact assessment and they are using internal studies. The rules are applicable within the EU and outside it. When it comes to interest rate reductions, again, we're working to the minimum standard. 30% is the top end of the scale. Member states can add more. Financial enterprises are currently excluded because discussions are still underway at OECD and are subject to further work. At the beginning of my statement, I said that fighting tax evasion and fraud and aggressive tax planning will not stop, and the OECD work will not stop either. This is not the end of the story. It's an important and significant stepping stone.